Hello and welcome to the discounted dividend valuation reading. Good news, if you've been through level 1, and why would you be watching these videos if you haven't, then you should know the basics of the discounted dividend valuation model. Nothing changes here, it's exactly the same. All we're going to do is introduce the H model on top of what we've already seen, and obviously, on the off chance you don't remember every single thing from level 1, we'll go through the basics as well. So, key point. When we're getting to an asset's intrinsic value, typically what we're going to do is work out the present value of expected future cash flows, expected future returns in some way. So there's the general formula. The value today at time 0 is the sum of all, so up to infinity till the sun explodes, all future cash flows discounted back to present value. All we're going to do is use the dividend as the cash flow. However, we'll start by comparing and contrasting and looking at other models that we might choose to use. The idea that we can calculate the intrinsic value is key, because we'll then compare that to the price and decide whether we've got an under, over, or correctly valued stock. So, what can we use as that cash flow? Clearly in this reading, we're going to focus on the cash paid to shareholders, the dividend. However, we could instead use free cash flows. You'll see two measures of free cash flow, to the firm and to equity. That's the cash available to go back to shareholders, a much broader scope. Or we could use residual income. And our residual income is an economic profit measure. All three you will see throughout this syllabus. We are focusing here on dividends. Key point, the valuation metric we choose, whether it be dividends, whether it be free cash flows to the firm, to equity, residual income, must be measurable and must relate to earnings power. So we must be able to link that back towards earnings. So, dividends, if we're going to use it, as we are in this reading, advantages tends to be less volatile than other cash flow measures. So free cash flow, particularly if the business is cyclical, could be all over the place. Dividends, if the company has a specific policy, could be very stable. It is theoretically justified. Why? Well, if you buy a stock and you're trying to measure your cash returns, the cash returns you get are the dividends. It makes sense. One argument is, well, hang on, you're just taking into account the dividends. What about everything else that the company made and reinvested? Well, there is this. Reinvested earnings give the basis for increased future dividends. So in that respect, they are taken into account. So the dividend discount model is a brilliant model. On the other hand, it's not. Downside, if the firm doesn't pay dividends, well, clearly your valuation using the dividend discount model will be 0. That makes no sense. Dividends might be artificially small for tax reasons, which means, again, you're not seeing a true picture of the business. And this is the most common one we talk about. Don't reflect the control perspective. If you're an investor buying the control of this business, then you will decide on the dividend policy. If you're controlling the business, what you're really buying are the free cash flows. So from a control perspective, you should really use a free cash flow model. Sustainability. Well, if dividends are sustainable, then the dividend discount model is going to be more appropriate. So this is appropriate when the company has a history of paying dividends, so you can see it happens over a long period. When you have, as I mentioned, a dividend policy, it's understandable and relates to profitability. Also appropriate for the non-control perspective, as opposed to control on the previous slide. And it will work for a mature, profitable firm that's not growing rapidly, because that's when you'd expect to have a nice, constant dividend. So that's when it's suitable to use if you have a sustainable, predictable dividend. What about free cash flows? Just to contrast, to give a different viewpoint, well, free cash flow is the cash flow that's potentially distributable back to your providers of capital. If you measure free cash flow to the firm, then you are measuring cash flow distributable to all providers of capital. That's both debt and equity. Any valuation model you use based on free cash flow to the firm will therefore value debt and equity. If you want to isolate just equity, well, free cash flow to equity will show you the cash flow that's distributable just to equity holders. You'll see awful lot about that in study session 12. Key difference, free cash flow to the firm is before interest, free cash flow to equity is after. Residual income, well, we said it's an economic profit measure. Again, you will see all about it in study session 12. It is earnings in excess of the investor's required return. Very much a definition of economic profit. If you make a zero economic profit, you're making just enough to keep investors happy. Anything in excess of that is economic profit. We're calling it in this model residual income. They are the three big models you'll need at level 2. Dividends, free cash flows, residual income. So, having compared and contrasted, let's get on with the main business of this reading, which is the dividend discount model. Key tasks. Step 1, we need to know the future dividends. I think that is fairly obvious. Step 2, we need a required return because we need to discount those dividends back to present value. Step 3, once you have the dividends and you have your discount rate, the value is the present value of all future expected dividends. And there is a general formula. We saw it earlier on. We said we are going to discount back all future cash flows back to today. Well, we're just saying the cash flow in this model is the dividend. Downside, we have to get dividends forevermore, an infinite stream. So we're pretty much at some point going to have to use a terminal value. So that's your basic model. Let's have a look at the easiest version when we apply it, which is the single period DDM. If you have a single period question in the exam, the key is that you're given a stock price in the future. We're referring to that as the terminal value. If you believe wholeheartedly in the dividend discount model, then you believe at any point in time the value is the present value of all future dividends. So here we have next time's dividend discounted, and then we are told at T1 the price of the stock at that point. Well, if you're a believer in the dividend discount model, as I say, that price should be, at that point in time, the present value of all future dividends. So if we include P1, discount it back to today, we have the value of all dividends. Note, there are two cash flows in this final period, so you've got the dividend and the price, discount them both back to today. Absolutely simple version, let's put it into practice. We're looking at a stock called WTC, and we want to know is it over or undervalued. Current market price, $60. We are going to compute from our dividends and intrinsic value and compare it to that $60. Expected year-end dividend is $2. Get into good habits. That is the year-end dividend. It's expected, hasn't happened yet, which means that is D1. Crucial. Expected year-end stock price, when you see that, you know this is the simplest model of all. It's going to be worth $64 at time 1. That's our terminal value. We are just gifted a discount rate. We are going to discount these two cash flows back by 8% and get ourselves an intrinsic value. So throughout this reading, there are quite a lot of really nice examples. Clearly, feel free to pause at any point, have a go at the calc before we reveal the answer. That's what I'll look like if you pause it. But let's move on and have a look. We've got P1 of 64, D1 of $2. That means $66 received in a year's time. Discount back by 1 year, that's 1 plus R, 8%, gives us $61.11. That is our estimate of the intrinsic value. Well, remember, the market price was 60. We think it's worth 61.11. We can buy it for 60. It is indeed undervalued. So current is 60, intrinsic 61.11. We would buy. Okay, that's the easiest. What about a two-period model? Well, no different really. We're just given D1 and D2 and a price at the end of year 2. So let's discount D1 back to today. Then at D2, you've got the second dividend and the terminal value. Discount those back by 2 years. That's a 2 period. Let's have a look. We've got the Holtzgraf company selling shares for $50. So market price today is $50. Under or overvalued, given D1, so it's the expected year 1, so that is D1. Expected year 2, so that's D2, and the price at the end of year 2. Discount those cash flows back at 13%. So once again, a good example to pause, have a go at it before I reveal the answer. Here it is. We are discounting back D1 for 1 year at 13%, then D2 and P2 at 1.13 squared. Be careful, this is T2, so you need 2 years. Add it all together, intrinsic value is 53.18. Under, over, or correctly valued? Well, current market price is 50. It is, again, undervalued. I'd be quite happy to buy at 50 because I think it's worth 53.18. And then you could go on for as long as you like. So we've done 1 period, we've done 2 periods. As long as you have a price at some point in the future to act as your terminal value, you can do n periods. I think it's unlikely in the exam you'd be given any more than 2 or 3 periods because it doesn't really achieve anything. So we don't want to have to go for 50 years and keep discounting individual cash flows, so there are simplifying assumptions, i.e. a way of getting to this terminal value. First one, easiest one, you will no doubt be familiar with it, is the Gordon growth model, the constant growth model. Secondly, we have a 2-stage model. Well, again, you'll be familiar with that, or at least you saw it at level 1. We'll have a high growth stage, and then just like that, all of a sudden, we'll have lower growth. Well, not that realistic. The new model that we haven't yet seen is the H. Slightly more realistic than this 2-stage. We have high growth and then bang, low growth. More likely, your growth will gradually fall down to its long-term level. That's what the H model will assume. Definitely need to be able to do all 3 of those. Fourth one, well, just do an end stage. Predict dividends for the next 15 years individually, or a spreadsheet approach, just start to model out your cash flows. Not practical as an exam question. You're not going to get Excel in the exam. So it's the first 3 that we need to methodically work through. Starting off with the old favorite Gordon growth model. Value today is D0, last time's dividend, grown by a year to get D1. So the model starts on the top with D1, which is last year's dividend with a year's growth, divided by R minus G, required return, minus the sustainable growth rate. If you're going to go wrong with this simple model, it will be here. So make sure in the vignette you note which dividend you've been given to start off with. If you're given last time's dividend, grow it before you use it. If you're given an expected year-end dividend, you've already got D1. So be careful. Let's have a look. Assumptions. Well, D1 is expected in 1 year's time. We're not going to mess around with mid-year dividends. The constant growth rate will go on forever, and this model will only work if the growth rate is less than the required return. If that doesn't hold, then R minus G becomes negative, and you get a nonsensical valuation. Never ignore a list of assumptions. Always good questions to fill up a vignette. Situations where it's useful. Well, we kind of talked about this earlier on. It's when you've got stable, predictable, believable dividends that are related to profitability. So that means mature firms, you can use it for a broad-based equity index, so as an overall kind of average growth in dividends. We can use it as the terminal value in a more complex model. So, for example, slightly more complex is the 2-stage model. Then we'll value the dividends in the early high-year growth, and then use a constant growth model to get the terminal value. You can use it internationally. Just be careful if you're looking at broad-based equity indices. Typically, you'll find different countries have different dividend-paying policies. Empirically, you can look back and see some countries typically pay out lower dividends than others, so take that into account. And we could also use it to come up with a justified PE ratio, even. You will see that in study session 12. So much more about that trick in there. Okay, let's do it. We have Doug, Inc., and then a whole host of punctuation. Doug paid a dividend yesterday of $1.50. Well, get used to this in the exam. Paid a dividend yesterday. That $1.50 is D0. So be careful. Get into very good habits. Don't throw away easy marks. Note for yourself in the vignette, that's D0. I will need to grow it for a year before I calculate the value. Dividends are expected to grow at a long-term constant rate. That means I'm going to use the Gordon growth model. Staringly obvious on this slide because it's titled the Gordon growth model. In the exam, you might not be told how you're going to do this. You've got to spot clues. If we have one single long-term growth rate, that's your cue to use the Gordon growth model. Required return is 10%, that's R. So we have R, we have G. Quick logic check. R is greater than G, so this is going to work. I will discount D1 by using R minus G. So D0 is $1.50, grow it for a year to get D1, over R minus G, 10 minus 5%, we get $31.50. Fairly straightforward, constant growth model. Right, slight sidetrack before we go into the other models. PV-GO, the present value of growth opportunities. What we're doing here is breaking the value of a firm down into its value if it had absolutely no growth. So if it's got absolutely no growth, value of the firm would simply be earnings divided by required return. So your assets earnings currently in place, because nothing is going to change. Why are we kind of putting that here on the back end of the DDM? Well, you can see how to derive it from the Gordon growth model. We said in the Gordon growth model, value of your firm is D1 over R minus G. Well, if I want the value of a no-growth firm, G is 0, it's simply D1 over R. And if there's no growth, well, there's no reinvestment. If you're not growing, you are not retaining any of your earnings, so you would pay everything out as a dividend, so that becomes E1. Hence, the no-growth firm should have a value of E1 over R. That is just a perpetuity. You know that formula is a perpetuity. Take the cash flow, divide by R. Well, here we're saying the cash flow is total earnings. Nothing is reinvested. Well, that's the value of the no-growth firm. If we can work that out, that's no growth. And we know the current price. What's missing is PV-GO. We can work out the element of that price that's attributed to future growth opportunities. It's a nice little LOS and a nice little calculation. So we can get PV-GO and, rather handily, turn it into a leading PE ratio model. All we do is take the formula we just looked at. So remember we said, if I have the current price, that's made up of the no growth value, E1 over R, plus PV-GO. All we're doing is dividing through by E1. So you can see, divide by E1, we get P0 over E1. The current price over next year's earnings, that's the leading PE. If I divide E1 over R by E1, I just cancel that out. It becomes 1 over R, plus PV-GO over E1. What does that tell us? Well, something, again, rather entertaining. 1 over R should be the PE ratio, the leading PE for a no-growth company. So, with no growth, PV-GO is 0. Your PE ratio should be 1 over the required return. The extra term, clearly, this one is the P component that's related to growth. So, good exam question. You're given the leading PE. you're given a required return, and you're asked how much of that PE ratio is attributable to growth. Well, work out 1 over R. You know how much that is. You can work out PV-GO over E1. It's good stuff. Right, justified price multiples. We said we'd do this in study session 12, but we might as well see it whilst we're here. P0 is D1 over R minus G, your classic Gordon growth model. Well, let's divide both sides by E1, and we get P0 over E1 is D1 over E1 over R minus G. D1 over E1 we know and love as 1 minus B, that is the payout ratio. D over E. How much of earnings are you paying out as a dividend? The payout ratio, 1 minus B. B itself is the retention rate. So the payout ratio is 1 minus the retention rate. Much more on that in study session 12. Okay, when should we use the constant growth model? Well, when we've got a history of dividends, understandable dividend policy that's consistent, sustainable, and relates to profitability, a non-control perspective, mentioned that a couple of times now, minority shareholders get dividends, and mature, profitable firms without high growth. Fairly intuitive, I think. Strengths. Well, you can use it for broad market indexes that are nice and stable. Be careful. Developed markets work well. If it's developing, growth will be too fast and too volatile. We can use it to estimate G or R. So if we've got the price and we believe that it's priced correctly using the dividend growth model, you can reverse out the implied growth rate or the implied required return. As we've seen, we can use it to get PV-GO. Or, as we mentioned earlier, we can use it as the terminal value in a more complex model. Weaknesses? Well, garbage in, garbage out. If you use terrible estimates of R and G, you'll get a terrible valuation. And if you do have a spare minute here and there, and you're kind of happy with this material, play with the other examples. Just see how much your valuation changes with just slight tweaks to the required return and the growth rate. It's difficult to use with non-dividend paying stocks. That's definitely true. You have no dividend to work with. And for the third time, it's a minority perspective, therefore not useful for M&A, mergers, acquisitions, much more common to use a free cash flow model. Okay, let's finally get to those more complex models, the multi-stage. So, GDM, a single stable dividend growth rate forever, probably unrealistic. So, spreadsheet modeling says, let's break out the Excel spreadsheet and let's start to model out individual dividends forevermore. Not going to happen in the exam. We need the two-stage, the H model, and the combinations of two-stage and H, the three-stage model. So we can look at growth in distinct phases. An initial phase. So initial growth, very rapid, tends to give us rapid EPS growth, negative cash flows in the company's initial growth phase, so it's a startup, tends to be losing cash, and we tend to have pretty much no dividend payout. So the return on equity tends to be greater than required. Transitional phase, two-stage is most appropriate, so the H model we'll look at. Sales EPS are growing, dividends start to increase, ROE settles down towards the required return, free cash flows turn positive. And then when we get to the mature phase, as we've already said, the Gordon growth model will be appropriate. We're growing at the economy-wide rate, we've got positive cash flows, and ROE, the return on equity, is equal to what's required. Typified by high competition and saturation of the market. So companies going through those phases, you might be asked in the exam to identify which model is most appropriate. I'll probably start with number 3. We know if it's mature, GDM will work. Transitional, it's kind of on its feet but still growing rapidly, but it's slowing down. Two-stage, the H model. Very early phase, three-stage model. And we have to look, as I say, at each. Terminal value. Well, we know we can get the terminal value using the Gordon growth model. We've said that a few times. Alternatively, we could use multiples to get there, and again, we'll see a lot of that in study session 12. So the terminal value, it's a forecasted value at the beginning of the final mature growth phase, known as the future sales price. Either use PEs or the Gordon growth model. So we've set the scene. Let's have a go. First of all, the two-stage model. You have seen this at level 1, so it may look familiar. We have a period of supernormal growth. During that period of supernormal growth, you'll find the present value of individual dividends. Once growth settles down to the indefinite period, well, we'll use the Gordon growth model. Useful if you have that sudden drop. High growth, bang, low growth. Not realistic, as I say, unless, well, you can see a pattern expiring where all of a sudden, yeah, your growth will drop off. Or ferment is a mature phase of the life cycle after rapid growth, so suddenly things calm down. That is your two-stage model. So, problem with a two-stage, probably single growth rate doesn't work, so we'll have rapid growth and then a drop-off. So here's the high growth, and then all of a sudden, bang, we have lower growth. We will find in stage 1 individual PV of dividends, and then going forward, we'll use the Gordon growth model. So here it is, initial high phase, then perpetual. Two approaches: learn the formula or write down your timeline to make sure you know where the dividends are. I would always recommend writing down the timeline, because then you can check that you've got each dividend captured once and only once. So let's have a look. Methodology: work out your supernormal dividends, then the terminal value. Note, key concept, the value is the early dividends individually PV'd, and then the present value of that terminal value. Getting the timings right is the key, hence our use of a timeline. So, Gordon growth model or multiples could be used for the terminal value. Here we go, finally, with an example. So, dividends, $2.50 and $4 each of the next 2 years. Again, get into good habits in the exam. I interpret this, dividends of $2.50 and $4 at the end of each of the next 2 years. I think they've given me D1 and D2. After that, our stage 2 constant growth. So once we hit constant growth, I can use the Gordon growth model. Is 4%. Required return is 12. Calculate the value today. So again, if you're comfortable with this, pause and get the answer. But here it is. This is how it's going to look. For 2 years, we have the high growth. So at time 1, we'll get $2.50. Time 2, we'll get $4. After that, we get the stable growth of 4%. So once you hit the stable growth rate, we are using the Gordon growth model. So $4 was our final dividend in the high growth phase. I'm going to use that as a starting point for my Gordon growth model. So I start with D2, grow it for year by 1.04, so that's into 1 plus G, and then divide it by R minus G, required return minus the constant growth rate. Now, multiply that out, what you should get is a terminal value of $52. Terminal value of $52. Key question is, what time is that terminal value at? Well, look at the formula. I've put D2 into 1 plus G on the top, which means D2 into 1 plus G is D3. So I've taken D3 over R minus G. That will give me a terminal value at time 2. Remember our standard example of the Gordon growth model when we met the formula first? It was P0 is D1 over R minus G. It's simply the mathematical formula for the present value of a perpetuity with growth. And these formulas always You start with the cash flow at the end of the period. If I start with D1, I get the price at time 0. If I start with D2, I would get the price at time 1. If I start with D3, I get the price at time 2. So whichever dividend you've used, you get the terminal value 1 period earlier. Hence, I've got D1 at time 1 of $2.50, D2 at time 2 of $4, and then the terminal value at time 2 of $52. That is the value at time 2 of D3 onwards. All that remains is to discount back to present value. So, 250 was at T1, therefore bring it back 1 period, divide by 1.12. $4 was the second dividend, that's at time 2, along with your terminal value. Those two together, $56, both at time 2. You can discount them both together by dividing by 1.12 squared. Add those up, and you should get $46.88. Excellent work. What about the H model? We've seen the constant growth. We saw it before at level 1. We've just seen a 2-stage, which is quite good fun, but we'd already seen it. We want something new. I can sense you're hankering for something new. Well, here it is, the H model. The H model assumes a gradual decay in growth levels. So it's not high and suddenly low, but as the firm matures over its transition period, your growth gradually drops to a constant level. So we were high here, we're just on a linear basis dropping down to our long-term growth rate. That's the characteristic of the H model. Some sort of phrase like that is what you're looking for in the exam as the clue the H model is relevant. So, let's put it into practice. Problem, 2-stage assumes high growth suddenly drops. The H is more realistic that it gradually falls. The key is to spot a firm with a high growth rate, and then in the vignette, information that growth will decline linearly over some transition period. That period we're calling 2H. You'll see why that's relevant in the formulas shortly. It's just an approximation. It's more accurate when the difference between growth rates is small and the transition period is small. The problem is, it's a massive assumption that this drop is linear. Here's the formula. Looks pretty nasty, looks pretty long, really isn't that difficult to get into your head. We're saying this, the value today is D0, the dividend that's just been paid, times 1 plus G over R minus G. Forget this for the moment and focus on that left-hand side. The value is D into 1 plus G over R minus G. This is quite simply the Gordon growth model. D0 into 1 plus G over R minus G. You've just got to make sure that you use the long-term growth rate. It will be the lowest, the long-term, the lowest growth rate, what it settles down to eventually. What you're doing in that first term is getting the present value of dividends as if they were always from now growing at that lower rate. What you then have to do is add in the value of those dividends as the growth rate is falling from the high down to the low level. What does it look like? Well, D0 times H, the transition period over 2. Why over 2? Well, what we're doing here is effectively getting the area of a triangle. Our Gordon growth model will capture the value of dividends growing at the lower rate forever. This second term is getting the area of this triangle, hence the over 2. Might just help you remember it. So, H is the transition period over 2. GS minus GL, that's the high growth rate minus the low. And this is easy to remember. The denominator exactly the same as it is in the Gordon growth model. So the left-hand side is just GGM, so it's D0, 1 plus G over R minus G. Second term, D0 times H into the difference between the growth rates, again over R minus G. Just got to learn it, practice it a few times, it will stick in your head. So let's put it into practice. Here we have the example, it's the B team. We'll go through the data and to try and keep yourself excited, imagine this is the real exam. Get yourself hyped up. Exactly, attack this exactly how you would in the exam. So, B team currently pays a dividend of $1.30. Currently pays a dividend of $1.30. That tells me current, that is D0. Stage 1 growth rate is 25%. That will be a flag for me in the exam. Stage 1 is 25%. I can't simply use the Gordon growth model. So that's high growth, so I just label that. Oh, look, that's high growth, short-term growth. Growth is expected to decay over 5 years. That screams to me in the exam, H model. It's going to decay over 5 years. The H in the formula would therefore be 5 over 2. 2.5, if you will. And that's what I would do as I review the vignette. My exam approach, I always look at the 6 questions that are about to come up, glance through them, that'll take 30 seconds or so, then I pick through the vignette, identifying what I need. So one of these questions might have been, use an appropriate dividend model to value B team's shares. Okay, having glanced at that, when I look at the vignette, an appropriate dividend model, I need D0. I then spot 2 growth rates, a high growth rate, and here a constant long-term low growth rate, and this word decay. That tells me, I label up the vignette, it's going to be the H model. Required returns, the final piece of the jigsaw, is 14%. Big problem you have in the exam at level 2, fundamentally different exam to level 1, you have vignettes to churn through. You want to try and turn the 1.5 pages of random vignette information into a nice, tight list of relevant facts. That's why I do this kind of thing in the exam, label up the vignette. So everything now is staring you in the face and the calculation will be easy. Easy if you know the H model formula. Phenomenally difficult if you don't. So here we go, the solution. This is what we're looking at. We've got a long-term and a short-term growth. The triangle at the top is that second term. Remember, D0 times H times the difference in growth over R minus G. So this area is D0, the current dividend. 2.5 is the transition period over 2, decaying over 5 years, divide it by 2, times the difference between high and low growth, the short-term and the long-term growth. Well, short-term was 25%, long-term was 5. So there we go. Final term, 0.25, oops, sorry, gone too far, 0.25 minus 0.05. Over R minus G, make sure you use the long-term low growth rate in the denominator. That area, that triangle, $7.22. So that, I think, is the trickiest formula to remember, because that's the new bit. So work on getting that into your head. If you can remember DO, D0 into H, difference between growth rates, you're home and dry, because the denominator is, as it always is, R minus G. So when people write emails to me and say, do we need to learn the H model? Is there a shortcut? Yes, you need to learn it, but it's straightforward. It's D0 times H times the gap in the growth rates. Everything else you already know. It's always over R minus G. And this bottom rectangle is just your absolutely standard Gordon growth model. D0 into 1 plus G over R minus G. Just make sure you use the long-term growth rate. Another useful fact, short-term growth rate is only used in one place in this entire formula. It's in there. Use the long-term everywhere else. So D0, 1 plus G over R minus G. and you get 1517. Add the two together, and you valued the stock. 722, the 1517, 2239. Now, another common, not complaint, but observation that people make is, look, this is going to take me a long time. Yes, it is. In the exam, you will get 2, 3, 4, 5, I don't know how many, but some long calculations. You will have enough questions that are short to balance that out. So don't panic. If you want to, maybe leave this till the end of the exam. In level 2, personally, I like to do an entire vignette or not. I don't like to do parts of a vignette and leave questions, because that means coming back and reading the entire vignette again, and that's a recipe for disaster. But maybe if you glance at the 6 questions here, you see there's a big H-model calculation to do, fine, maybe that's the vignette you leave till the end of the exam, because my feeling is when you're tired, big, long calculations are the best things to do, rather than having to deal with questions of increase, decrease, stay the same. This is just mechanical. So there it is, the H-model in all of its glory. Work out the two elements, put them together, and you get 2239. If you're comfortable with the formula, you may have spotted the first term is over R minus GL, sorry, the first term and the second. So this version just puts the two together, divides it by R minus G, still gets the same 2239. Great stuff. Well, any other models? Well, you could be asked to come up with a 3-stage model. You may have 3 distinct phases. Well, simply add an additional growth stage to your 2-stage model. You may have a high growth phase and then the H model. So you've got high growth for a while, then we linearly decline, then we've got low growth. Well, this bit is the H model. Get the triangle, get the Gordon growth model, discount that back to today, and add in the early high growth dividends. It's just longer again. That's all it is. Benefits, strengths, well, obviously, they allow you to model out a lot of different growth patterns, and this always scares people. Once again, you can reverse out G or R. Our usual approach is to use this formula, as we've just done, to calculate V. But you could reverse that. Let's imagine we knew V, so we were told 2239, but we didn't know the required return. Well, we could put in the price, put in the dividends that we know, put in the growth rates that we know, and we could solve for R. Or we could solve for GL, and so on. Does involve a bit of algebra, rearranging the equation, so practice it. But if you're lucky, and most of the time you are, because it's multiple choice, you'll have 3 options for G or 3 options for R. Plug one of the options in, see if it works, see if it gives you the right value. Weaknesses, again, garbage in, garbage out, just like any of these models, sensitive to G and R. You make terrible assumptions about G and R, it will be a terrible valuation. Change G or R very slightly, particularly the long-term low growth, and again, it has a huge impact on your value. Model suitability, very important. Is this pattern, high growth, decay, low growth, consistent with this business? It will be if they're very, very new. Remember, if they're in that initial phase, yes, this will be relevant. But don't use it for the sake of it. Make your model parsimonious. Do the most you can with the least. If it is a stable, mature company, don't do this for the sake of it because it looks exciting. Stable, mature, predictable dividend, just use GGM. Single period, constant growth. Excellent. Talking of constant growth, sustainable growth, quick reminder, you've seen this in level 1, you'll see it again in financial reporting. We can calculate the sustainable growth rate, assuming we grow using internally generated equity, we have a constant capital structure, lots of other key ratios are held constant, all of that holds together, then the growth rate is the retention rate times NI over SE, that is return on equity. Net income divided by shareholders' equity. So retention rate times ROE, again, we already knew that from level 1. Why is it useful? Well, obviously we need the sustainable growth rate to get our dividend valuation model. We can go back even further and say, look, if I want to get the sustainable growth rate, it's the retention rate times ROE. How do I get ROE? Well, if the examiner's being kind, you have net income and you have equity. If he isn't, he might get you to calculate ROE using old friend DuPont. ROE is margin times asset turnover times the equity multiplier, assets over equity. Assumptions here, unless you are told otherwise, so be on the lookout for any other assumptions, but unless you're told otherwise, use beginning of year balance sheet figures. Now that's important because you may have learned elsewhere in your studies, maybe in level 1, that any time you see an income statement figure divided by income statement figure divided by a balance sheet, then you use the average balance sheet figure. Not here. Unless you're told otherwise, when you're doing this DuPont analysis, use beginning of year balance sheet numbers. So the ultimate question, you find ROE using DuPont. Once you have ROE, times it by the retention ratio to get the sustainable growth rate. Once you have the sustainable growth rate, plug it into a dividend model to value your equity. Good stuff. What drives the sustainable growth rate? Well, we've just seen from DuPont to get to ROE, margin, asset turnover, and multiplier, financial leverage. Margin is profitability, higher margins, higher ROE. Sales over total assets, that's efficiency. Given the asset base that you've employed, what is the volume of sales you generate? So a higher sales to total assets, a higher asset turnover, higher ROE. You're getting more sales volume given your asset base. So if you compare these two, I often like to think of them as kind of quality of sales and quantity. First, the margin says, how much profit do you make per dollar of sales? That's kind of quality. Second one, sales over total assets. Using your asset base, how many dollars of sales do you make? So you can have two companies with fundamentally different business models, getting fundamentally different margins and asset turnovers. A company at the high end of its industry, so let's say food retail, if you're looking at the high-end food retailers where it's nice to walk around their stores and everything costs an absolute fortune, they're going to have really high margins. So you think, yes, really high margins, we're going to get a huge ROE, but it costs a lot to make those stores look nice. They have a huge asset base. So their efficiency is not so good. That brings ROE down. Or you look at the very low end, pretty ragged looking stores out in the middle of nowhere. Everything's cheap, terrible margin, but very small asset base, really efficient. Huge asset turnover drags the ROE back up. Whatever your business model, you can always then boost ROE using leverage. Assets over equity. So, total assets over how much of that asset base is financed by equity. The difference between total assets and equity, liabilities. So the bigger that ratio is, the bigger the gap between assets and equity, the more is being financed by debt. And what that means is you'll get a higher ROE. Why? Well, if you've got a huge amount of debt, tiny amount of equity, your return on equity is going to be larger. So, as important as calculating the numbers is being able to identify the drivers of those numbers. Spreadsheet modeling, we keep saying we're not going to do in the exam. Clearly, it is the most flexible. Every model we've looked at so far has huge simplifying assumptions in there. Even the three-stage model simply says high growth, linear decline, low growth. In reality, it's probably all over the place. So, in that case, let's just pick off and identify every single individual dividend. So, get your base level cash flows, come up with a method of forecasting deviations for several years, and then normal growth beyond that, and discount everything back to PV. Just gives you, as it says, a little more flexibility. That's it. Key, well, it's going to be on the exam. Rarely do we stick our neck out and commit to this kind of thing, but we're saying this will, and just, I'm going to say 99.9% sure, just so I've not committed, 99.9% sure this will be on the exam. You can't get around valuing equities. So you've got the 5 forces in there again. Don't overlook them. You've got an entire reading to talk about. You've got single, constant, 2-stage, 3-stage H models. Make sure you don't overlook the chat. Don't get obsessed by the formula. Never ignore a list of strengths and weaknesses when it's appropriate, when it's not. Make sure you see some examples in Schweizer where you're solving back for growth, deriving growth from the models, and look at your sustainable growth rate and your DuPont, and you'll be in business.